Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Markets are sort of lukewarm and have been selling off a little bit earlier today from all-time highs as they digest the multipolar world that appears to unfold further each day of this new year. With such massive upheavals, can we get clear signals to further opportunities abroad now, or will an interregnum create a desire to run for defensive stocks? Is the U.S. equity market the bastion of safety as it houses the hyperscalers and the S&P 500 companies being transformed by AI? And which asset classes win from this emerging playing field? It appears gold certainly will power forward, but what else? And where else geographically? Joining us to discuss the macro landscape for investors is Fidelity Director of Global Macro, Jurrien Timmer. Warm welcome to you, Jurrien. How are you today?
I'm well. Good morning.
Good morning. And it looks like you are joining us from California today.
Yes, I'm finally made it here after 3 months of being diverted to the other continent. So I'm happy to be here in some sunshine.
Oh, good. I'm glad you're getting some sunshine. Just before we begin our conversation, I'll just quickly mention that with everything that is happening overseas on the oil front particularly, we will be dedicating the last 10 minutes or so of the webcast today to the topic of oil and where Canada stands in the bigger picture. Equity research analyst Jin Wan will be joining us then, so it's for the final few minutes of this broadcast. And just to let you know that today's webcast is featuring live French audio interpretation. So there you go. You've got lots of options and things coming up. Jurrien, let's please begin and talk a little bit about what is going on ultimately in these markets. I mean, we really need you to guide us through a little bit of the developments and how we should be thinking about them. I mean, do we run for the hills? Do we watch markets that have powered through many geographical, geopolitical upheavals lately? Do we stand pat? What do we do with this information?
Yeah. Well, it is amazing to see the markets be so calm and resilient despite all the craziness that is happening around us. The incursion in Venezuela and what that means for the global world order. Even the news about the Fed and the Department of Justice. And last night the S&Ps were down 30 points, but they're basically unchanged. So the market just shrugs it off. As I guess they should to a degree, because the markets come down to earnings and interest rates, and of course the Fed is interest rates. But I think what is happening is we're seeing a cross currents of developments, right? So we have the things I just mentioned, but we also have this AI boom, AI revolution, I guess you could say. And there's always been sort of the glass half full view that the AI revolution starts with the hyperscalers, the Mag 7, and then hopefully eventually leads to a productivity boom that allows the U.S. and maybe the rest of the world to grow out of the debt and to allow the market to broaden in the most benign way possible. And of course, we have to be skeptical because we have to think critically. And the question always on my mind was, is the concentration risk too big to allow a friendly broadening? But we only are 1 week into the year, but so far it looks that that's happening. So if we go to slide 1, just to set this up, this is the MSCI All Country World Index. So this is the global stock market. And the global stock market is making new highs, basically on a daily basis out of this nice triangle there that you can see on the top of the screen.
And sorry, how much of that is U.S.?
The U.S. is about 65% of ACWI. So it is the U.S., but this new high actually is in large part also global. But what we see here, 67% of the global stock market is above its 50-day moving average, 71% is above its 200-day moving average. So we're in a world where 71% of basically all the stocks in the world are in uptrends, and that's a pretty nice tailwind to have. Now, if we go to slide 2, what we can see here is, so I show the S&P cap-weighted index, which is the one on top, and the equal-weighted index, which is the one with the purple line, on a similar scale so that you can compare the magnitude of the rallies. And what we're seeing right now is that the SPW, the equal-weighted index, really accelerated last week, and it did not come at the expense of the cap-weighted index. And to kind of take that one step forward, if we go to slide 3, we can see the Mag 7, of course, those stocks that have been at the forefront of the AI boom, and the Mag 7 are basically doing nothing. While the market is broadening out. So if you look at the bottom panel, so that's just a month or so ago, only 32% of the stocks in the S&P were above their moving average, and now it's 71%. So the market is broadening. The SPW is accelerating higher, but it's not coming at the expense of the mega cap growers going down. They're just kind of treading water, which really, you may not like them treading water if you're invested in them, as we probably all are, but it's still a nice thing to see that you can have a rotation that is not a zero-sum game.
Exactly.
And that, I think, again, we don't know if it's just sort of beginning of year stuff or whether there's a larger theme that the AI boom is paying a dividend basically downstream into the broader economy. And again, it's too early to know, but just from the first week of the year, it's a very constructive thing to see.
And as you say, on top of it, which you started off with, the rest of the world is seeing growth as well across equity markets. So there's a number of things that are being held up, even if there is a bit of a range-bound situations for the so-called hyperscalers.
Yes. And I'll show you slide 7, which is the MSCI EM index. That finally bested its high from 2021 just last week. And ex-China, it's been doing that for a while now, but even including China now, the emerging market index is very, very strong. You can see in the blue bars in the bottom is a Z-score of the index, and that's very strong. And the CRB Raw Industrials, which is a commodity index that tends to be seen as a gauge of global growth, is advancing nicely as well. And just to put another point on that, if we go to slide 6, we can see that earnings growth for the rest of the world, so ex-US, is accelerating quite rapidly now at a 17% year-over-year gain, even more so than the US, which is at 13%. And that has led to a 15 percentage point year-over-year outperformance now of non-US stocks relative to US stocks. So this is not a US story. This is a global story. And if anything, the global markets have even more momentum than the US market. So again, as global investors, as of course you all in Canada, somewhat have to be, given that that's where most of the market cap is, it's a very nice thing to see.
It's very interesting to see how this idea of something else that is very global has been the gold trade, and we've seen that literally across the globe, but also various commodities catching up as well and sort of catching wind in their sails. If those that are bullish in this regard will say that there's a new commodity super cycle on its way, I don't know if you go that far, but tell us what you do see.
Yeah, so my sense is, and I wrote this up on Sunday, and it'll be on LinkedIn probably later today, is clearly the post-world order, the post-war world order from World War II, where the U.S. was this benign, dominant influence, doing the right thing, and the benefits accrued to the U.S. as well as the rest of the world. Clearly that seems to be over, and it's a much more transactional, mercantilist type of setup. And the news in Venezuela kind of put a point on that. If anything, we're kind of back to 19th century sort of imperialism, or a world order that is multipolar, where there are different spheres of influence, if you will. So the U.S. Western Hemisphere, at least that seems to be the Monroe or the Donroe doctrine, and then you have Russia and China. In that environment, that is the opposite of globalization, of course. It's fractionalization, I guess you can call it. That should be more inflationary, and I would say that the commodity markets become less fungible in that sense, right? Because commodities will be a strategic asset for every sphere of influence. And so I would say that that makes the commodity market less efficient from a price point of view and more demand driven. And that should be good for commodities. And in a way, I would say maybe what gold has been doing the last 3 years has been kind of this message that it's been putting us in our face, saying like, this is why this is happening. So if we go to slide 8 and you look at the Bloomberg Commodity Spot Index, and you look at the performance of commodity sensitive equities, I mean, that is a beautiful chart, a technician's dream. Like you have this base and then a breakout. The stocks, the confirming asset is confirming that move. So I think commodities, and we're seeing this with copper very strong. We're seeing this with nickel, even with silver. There's a lot of stuff going on here. And if you look at slide 10, from a secular point of view, so instead of a short-term chart, a very long-term chart, you can see, as we navigate the stock market into what I think are maybe the later innings of a secular bull market, which you can see at the top there. If we look at the long-term rate of change for commodities, which is the gray line in the bottom panel, that trade, that asset, as well as the relative performance of, let's say, international versus U.S. and value versus growth, have been sort of lining up to make a secular low, and commodities are sort of front and center in moving there. So we might very well be in a new secular uptrend for commodities as well as cyclically. So obviously, that's going to be music to the Canadian ears. Yes. But I think the nice thing about commodities is, so over the very, very long term, if you put commodities on an efficient frontier chart, they're not a good strategic asset because they're very volatile, and they, over the very long term, like 50 years, they produce the inflation rate. So it's not a great risk reward on a secular time frame. But if you look at slide 9, here I show a bunch of Sharpe ratios for all the assets that I track. You can see the commodities are kind of uncorrelated. So as an uncorrelated asset to both stocks and bonds, you have to be choosy as to when you want to own them, but when they do work, they work really well. And I think as a diversifier in a portfolio, they make a lot of sense right now.
Let me just press you on that, the uncorrelated to both equities and bonds. Do we need that right now? I mean, is there any concern that there's a slide of the two of them being correlated more than we'd like them to be?
Well, certainly 2025 was a great year for both stocks and bonds. Yes. So they were still positively correlated, but in the good direction, right? Yes, so yes. Not in a 2022 type of direction. So the Barclays Ag, the Bloomberg Ag delivered a 7% return, the S&P an 18% return. So from that perspective, you did not need any diversifiers, but it's always good to have diversifiers in. And again, we've talked about this extensively in the past, that for me, I want to diversify more against bonds than stocks. At a 4.17% yield on the 10-year, I don't see a lot of value there, which doesn't mean we shouldn't own any bonds, because they do generate a positive real yield. But you look at the shenanigans, now with the Department of Justice and Jay Powell.
Yeah, is he going to be okay? I mean, is Jay Powell going to be okay? We need to ask this question.
Yeah, I think he's going to be okay, but it's just sad to see. I've met him. We know him well at Fidelity, and he's just he's a well-meaning civil servant, and you need to have pretty thick skin to do that when Mr. Trump is in the White House. But he's seen that. He's seen that movie before, and he will be fine. And actually, it's interesting that a Republican Senator, Tom Tillis of North Carolina, came out and says, he's not going to approve any Trump nominations until this matter is settled. And I met with Senator Tillis a few months ago, and he said that in private to us, saying the Stephen Moran nomination, he approved that, but he's not going to do it again if there's these crazy games going on. So I think Powell will be okay, but it's unfortunate to see, and it does it does highlight the risk of a bear steepener in the bond market, that if the Fed's credibility really is jeopardized, and you get this fragmented Fed where the leadership does things that make no sense because they're Trump loyalists. The yield curve could steepen in a bearish way. The term premium go up, and at 4% on the 10-year, you don't really get a lot of protection there. And so that's why I think diversifiers against the 40 remain a good idea.
Okay, fascinating. No, it's really great to sort of get your calm voice on that one, because it's a challenging news headline to see, and you just wonder how that all.
Every time you think you've seen the craziest headline, there's another one lurking in the background.
Right. Don't ever say that out loud.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Let's talk a little bit about earnings. They're around the corner. This is Q4 coming in. I mean, there are a lot of indications that show that they should be right where everyone wants them to be, which is not far off earlier in the year, and Q3 was pretty healthy. Are we coming off some strange comparatives? What would you think of Q4 so far?
So let's pull up slide 4. So earnings season starts this week. The banks will start reporting in a few days, and like the chart shows, this is my progression chart going into the quarter, which is the vertical line there. And so what Q3 showed was very similar to what Q4 is showing right now, is that you came in at about an 8% estimated growth rate, year-over-year growth rate. And then you had the typical bounce that generally happens, and the bounce was very strong. And we went from 8% to 15%. So that was a 700 basis points bounce. I would imagine we could very well see something similar to that. And if we go to the next slide, 5, if you convert that into an annual growth estimate, you can see the round trip that you just mentioned. We started 2025 at a 12% growth estimate. We fell to 7 during the tariff tantrum as analysts were pricing in the cost of tariffs. And now we're back to 12%. And if Q4 delivers another bump, we could very well end up at maybe 13% or even 14%. And 2026 is starting roughly in that same area. So I think the earnings story continues to be very good. And actually, if we can skip to slide 18 for a second.
Okay.
One of the bigger questions has been, and not to derail the conversation here, but if you look at the bottom panel, the blue bars, that's the 5-year earnings growth, the annualized growth rate in earnings, so the 5-year CAGR, and that's now at 14%,
14%, that's
which is obviously very good, but it's about as high as it ever gets. In 1997 we were at 14. In the 70s we were at 14, and so it does raise the question of, are we at peak earnings while we're also at very high valuation? So that is a legitimate question, of course. And if we go to slide 19, you can see that if you put the 5-year earnings growth rate on a bell curve distribution, you get the chart on the left. And if you put the PE ratio on a distribution, you get the chart on the right. So we're kind of near peak earnings and near peak valuations. And that sounds kind of scary, because if you're at peak everything, then there's only one way to go. But it actually isn't as scary as it sounds, because I looked into it. And if we go to slide 21, you can see all the earnings growth cycles over time, over the past 75 years or so. And you can see we're at the highest point that we tend to go. We've seen some exceptions to that back in the 20s and 30s, but those were sort of outliers. So it does seem that earnings growth on a 5-year perspective will moderate. But then the question is, what happens to the stock market? If we go to slide 23, you can see that it's certainly not an easy conclusion to say, okay, that means the market goes down or not. It really depends on whether the earnings growth rate just decelerates to a more sustainable rate. And right now, the expectations are that we go from 14% to 9%, which is still fairly good. If earnings were to actually contract like they did in 2008, which is the pink line, obviously it's a different story. But this picture, even though we're at the right tails, is a sustainable story as long as those earnings come through.
Because for some time, all of last year, you sort of said, yeah, the multiples are there. We really need earnings to grow into the multiples. And they've done that. So yes, it does kind of beg the question, what's next? But you've kind of said it's sustainable so long as. Okay. When you take a look at the labor picture, which of course is what the Fed has been looking at for some time, what are the nuances that you're looking at? The demand ultimately for labor, is there concern? How much of this is tied up in the rate story? We know there's a political overlay for the rate story, but just in terms of the straight labor concerns that the Fed is tackling.
Yeah, so if we go to slide 14, so clearly the labor market is soft. We saw that again with the jobs report last week, although the unemployment rate actually ticked down. We're kind of in a detente, if you will, where companies aren't hiring, but they're not really firing, and the labor force isn't really growing because baby boomers are retiring, immigration has slowed. So we're kind of in this holding period where the labor market is in rough balance, but it's certainly not growing. But at the same time, and so by the way, that's the gray line is what I call excess labor demand, and of course during COVID it plummeted as the economy was locked down, and then it rose sharply as businesses reopened, but the labor force wasn't quite there yet. And it's been moderating ever since, but it's now actually contracting ever so slightly. And so it's an interesting juxtaposition to see the labor market being soft. I wouldn't say weak, but soft, while earnings growth is accelerating. And actually, if we go to slide 13, you can see that the GDP estimates for the US are accelerating as well. So again, it comes back to what we discussed earlier in the show. Is this the AI dividend, right? Is it leading to is it leading to more growth, more productivity, higher earnings, but without an increase in labor? Because the point of AI is you can do more with less. Yeah. And it's anecdotal, but it's certainly a plausible explanation. And if you can increase productivity and growth, even if it doesn't come with more labor demand, as long as it doesn't lead to less labor demand, maybe that's still a win-win.
It's really interesting. How else would you set us up for this week on sort of the macro front in terms of, so the earnings are something to look out to. We've got some inflation data coming in. What else do you think investors need to know? It is a topsy-turvy time. We'd love to just sort of get your thoughts set us straight here for the week at least until we see you next week.
Yeah, so obviously earnings will be important, and the banks are always a good bellwether on that. The stuff about the DOJ, I'm going to ignore it to some degree because it's their strategy to have a lot of bluster and a lot of attacks, and I think that's sort of part of the art of the deal is to put people on notice. But hearing that from Senator Tillis was certainly comforting to some degree, but it's a strange new world, and the market has done I think a good job kind of deep compartmentalizing the headlines from the actual things that matter, which are earnings and interest rates, and so far I hope the broadening continues without it being at the expense of the leaders, because the leaders will drive the index progress.
Yes, and so far they still are. Jurrien Timmer, I want to thank you very, very much for setting us straight. I think we always look forward to a little bit of calm after a weekend such as this, or at least the last several days of the beginning of this year. Appreciate your help in framing this for investors. We'll see you next week. Enjoy California.
All right. Yeah, thank you. See you next week.
Okay, see you next week. It's Jurrien Timmer joining us today on FidelityConnects. So we're just going to take a few minutes now and bring in the man here in Toronto, Fidelity analyst Jin Wan, who takes a look at the oil services across the boards for the oil story and how it is developed over the course of the last few days. Welcome, Jin. You're in the hot seat on a Monday because I imagine you haven't done a whole lot except for stare at your screen and look at oil prices over the course of the last little bit. Welcome, though. Good to see you.
Yeah, never a dull moment in energy world.
Never a dull. And actually, sometimes there are dull moments, but this has not been one of them. Can we begin with, as we watch these headlines around Venezuela take place? The country essentially has been taken over at this point by the U.S., all about the oil. That's the reason for it, apparently. What does it mean sort of shorter term for the oil industry? Should we start at the global level, what this particular puncture means?
Yeah, sure. So it's probably worth just setting the table on what the Venezuela opportunity actually looks like. So just for some context here, Venezuela has the largest oil reserves on paper, even surpassing Saudi Arabia. Yet oil production barely even cracks the top 25 because of years of underinvestment, political uncertainty, all sorts of things. Today, they produce around 800,000 barrels a day of crude, so about 1% of total global oil supply. But 10 years ago, that was 2.5 million barrels a day, and 30 years ago, that was close to 4 million barrels.
And the reserves are all there, as you mentioned, so they can do that again.
They can hypothetically do it again, but that just ultimately goes to the question. When you hear the amount of reserves they have relative to how little they produce today, it naturally begs the question, can they actually reignite the energy industry, grow back to their prior peaks, and actually flood the market with kind of a lot of cheap barrels that we didn't really anticipate before? And that has massive implications to the oil markets more broadly, both to your point in the short term, which you've heard me describe as being kind of heavily oversupplied, at least for the foreseeable future, but also even for the medium and longer term, which you've heard me talk about as actually looking pretty bright, pretty undersupplied, and potentially even hearkening to those resource-scarce structural undersupplied days of the early to mid-2000s.
Yeah, in the longer term, and you've been telling us about that for well over a year at this point. Short term for Venezuelan oil, getting it out of the ground, getting it where it needs to go, some deliveries. Is that what will change structurally for them?
Yeah.
I mean, it sounds like they're kind of mothballed a lot of these operations.
It goes to the heart of the question that everyone's asking is, can Venezuelan production actually grow back to the highs it was at 20, 30 years ago? In the short term, the answer is yes, there is opportunities to grow. We heard the U.S. Energy Secretary Chris Wright speak not that long ago, and he described it as an opportunity of a couple 100,000 barrels a day in the short term from small investments.
Okay.
That comes from really two things. The first is Venezuelan crude has been sanctioned for a long time and very recently has actually been blockaded. You hear it in the news, there are ships actually stopping the tankers from leaving Venezuela.
Can't get it out.
Exactly. So removing that is actually a pretty big benefit right off the bat. The second piece of that is the sanctions go both ways. One is Venezuelan production couldn't leave the country, but a lot of the necessary inputs to production couldn't come into the country. Things like lighter crude to actually make the really viscous heavy crude actually deliverable. Once you remove those two barriers, then you could actually see a couple 100,000 improvement right off the bat, and that's sort of what the target is right now. Longer term, there's a much more challenging question to be had there. This is infrastructure that's kind of aged and has become decrepit over the last 10, 20 years, and can you really restart investment at a time when most oil companies, and they've said this publicly, aren't willing to invest really a dollar so long as there's political uncertainty.
I mean, this was the Friday meeting at the White House,
exactly.
right? So this was the Washington meeting that you were watching everyone roll up to. And I mean, it was very public. And the public consensus seemed to be too risky.
Yep.
We're not doing it, broadly speaking.
Yeah, and it really comes down to two things. One is these are multi-decade type investments that these companies have been burned on in the past. You saw it with a couple of the companies who were at this meeting who said, our assets were seized by the prior administration in 2007, and we are owed anywhere from $10 to $20 billion on those investments. We need to recoup that before seeing any incremental dollars come back to Venezuela. And the second piece is we need
wasn't that, sorry to interrupt you, but wasn't that sort of the carrot from the Trump administration?
Exactly.
Like, look, you guys are out a lot of money. Let's get your money back.
Exactly. And that may hold for some companies. For others, I think the burns of 2007 might be too high. But the bigger issue is, look, we need absolute security and political certainty sort of guarantees. I think that works fine under a Trump administration and has been willing to backstop that. what happens for the next administration, the administration after that? These companies drill oil not for 5-year projects, they drill them on multi-decade cycles. Right. And the risk of losing that after this presidential term is up is actually too great for a lot of companies.
So they need some, I mean, you would imagine in most countries, I mean, you tell us, oil operations, the oil fields themselves, are probably protected by the company's own security forces to an extent.
Yep.
But I guess that's under the umbrella of the country's security forces.
That's correct. And again, it just goes down to the best risk reward. We talked about a lot of these interesting opportunities globally, Canada being one as an interesting resource opportunity, but you hear about the things going on in Venezuela, in Argentina, Guyana, Brazil. There's a lot of resource out there for companies to go after. They don't necessarily need to be taking this incremental risk, which is why a lot of people do discount the opportunity around the medium, long-term production growth and really just focus on the short term for now.
Okay, so the feasibility of the longer term is a question mark? Could you go that far?
Correct.
Okay, interesting. So challenging longer term. For Canada specifically, it was a shock to hear this, right?
Yep.
I mean, it basically a competitor
Yep.
of enormous reserves ability. So just break that down for us, because I think it was a bit of a shocker.
Yeah, and it's definitely going to be the most topical as this Venezuela situation kind of unfolds. But to take a step back, it's important to remember that not all crude is created equal. Canada happens to produce a heavier grade of crude that U.S. refiners really like, and availability of that specific type of crude is really scarce these days. It effectively comes from Mexico, who's not really growing production. It comes from a lot of Middle Eastern countries that are under sanctions, and historically it did come from Venezuela.
Yeah.
The concern now is what happens if you take that 800,000 barrels a day, the majority of which was going to China, and let it flood back into the US markets and push away a lot of those WCS barrels that we have.
Into the Gulf.
Exactly. And shorter term, there is no doubting that this is actually quite problematic from a reserves perspective for us and kind of the differentials. But longer term, again, I will go back to that resource scarce argument that I've talked about in the past, where 26 still looks oversupplied, 27 looks a little better, 28, 29 actually look really good. What we're talking about with respect to the heavy crude availability from Venezuela, maybe you lose $5 a barrel off of your differential. But if we truly are in this resource scarce world in 27, 28, 29, because again, it sounds like Venezuela can't actually grow production, we're not talking $55 a barrel oil anymore. In those types of environments, we have seen $80, $90, $100 type oil. So maybe you lose $5 on a differential, but the overall oil price, the global benchmarks do rise in those types of environments.
Because the demand is there.
Exactly. And so we're being nimble around this opportunity. We understand that this is disproportionately bad for Canada, but we are not losing sight of that bigger picture. And when there are major dislocations within Canada, we will be prepared.
There have been some over the course of the last week.
And we will be prepared to take advantage of those, understanding the picture.
So Canadian producers drop, their equity prices drop.
Yep.
You can take advantage of that because you see a longer story.
Correct, yeah. And it's all about just being nimble. We've seen this market change basically on a tweet's notice. And so understanding, not losing sight of that medium to long-term picture, taking advantage of what is really risked as a $5 loss on your differential relative to potentially tens of dollars of gain in the actual global benchmark price is kind of the prize in the calculus that we're looking at right now.
For some time, though, we've been talking about the medium longer term in Canada, which is to find new clients, which is to get oil to Tidewater in different ways.
Yep.
There are plans. I mean, the Prime Minister, we think, is shoring up clients potentially in China right today. I guess it just adds an extra urgency, though.
It certainly adds an extra urgency. A lot of the expansions you've heard me talk about, even before talking about a net new pipeline, ultimately do just end up in the U.S. Gulf Coast and the Mid-Con. So it does still continue with the issue of the Venezuelan barrels. So we do need to look just beyond the U.S. market. We do need to build pipelines to the West Coast and see those opportunities through. But as of today, it still is fairly kind of long-term. It's a little further out, and we're kind of hoping to see over the next couple months as a lot of those pipeline developments happen and when those deadlines come through, maybe we could see a bit more progress on that front.
In terms of the slide in prices for the Canadian producers, some of that's come back a bit. Just tell us a bit about what it's coming back on.
Yeah, part of it is the broader kind of dynamics happening in Iran right now, which is lifted again. There's a difference you have to think about with the global benchmark and then the WCS prices. Yeah. We have benchmarks minus some differential equals your WCS prices. So when one of those moves, it's going to move the Canadian equities. Okay. The differentials have widened. We're at $15 to per barrel today. We were at $12 not that long ago, but oil prices have rallied this year from 55 to 60, and that's mainly on kind of the Iran uncertainty. So it's partly that, but it could also partly be that everyone understands the medium picture. If everyone's discounting Venezuela's ability to grow meaningfully, maybe that medium-term picture still looks intact, and you're willing to look past that kind of near-term sloppiness.
For some of the Canadian producers.
Exactly.
Well, what was almost a sleepy story last year is wide awake and fully caffeinated.
100%.
We're very glad to have you here today. Thanks for joining us.
Thanks.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.